Thank you all for coming to this evening's seminar presentation on how to save, reduce your lifetime taxes, and build generational wealth. Can you hear me in the back?
No, not very well.
How about now?
Oh, yeah.
Okay, good to go. Today's seminar is sponsored by Milestone Financial Planning and Divine Millimet. Theo?
Good evening, everyone. Thank you for coming out tonight, especially in this weather. I have the distinct privilege of introducing my co-presenter here this evening, Jen Climo. So I've known Jen now for a number of years. As you all know, she's a financial professional and a CPA. So she gets taxes. She understands taxes, which is very important in this context. There are a lot of things to like about working with Jen that I really, really, really like. One of those things is if there are other professionals on the team, estate planning attorney, if there's a CPA, an accountant, Jen will loop those people in. That way we're all pulling in the same direction. Because if we're off doing our own thing, we're separately siloed, then we're not serving the client so well. So that's a great thing. I also like working with Jen because I know if I do an estate plan for someone, if I do a revocable trust for a client and we need to transfer a brokerage or investment account into that trust, or if we need to name or update beneficiaries for retirement assets or life insurance policies, I know that through Jen's assistance, all of those things are going to get done. Thank you.
Thank you very much. Joining me today is Theo Vugias from Divine Millimet. I've worked with many excellent estate planners over the years, but Theo is the only one that I have worked with that both has a deep understanding of generational wealth transfer issues and is willing to do the tax compliance work associated with these strategies, namely filing gift tax returns and allocating generation skipping tax exemptions, which you probably don't know what those are, but we'll talk about those. Divine Millimet is also a full-service local law firm that I've personally worked with on many legal issues throughout the years. There's a lot of material to cover tonight, so we're going to be moving fairly quickly. My team and I will be available for any questions after the presentation, and you can also reach our team at info@milestonefinancialplanning.com or on our website. Do not make financial decisions based on this or any other seminar, but instead meet with a qualified financial advisor regarding your specific goals and financial circumstances. Note that almost all financial decisions will impact your income taxes or estate taxes now or in the future, and the tax consequences should be evaluated before you take action. Past performance of investments does not predict future results. Nothing you hear today is investment advice, and remember, we are being filmed for future posting on YouTube. Please be aware of that if you ask any questions during this seminar, but please don't let that deter you. There are lots of different types of taxes that reduce wealth. Taxes on consumption, assets, income, gifts to generations, 2 or more generations beneath you, and tax on wealth at death are the big ones. We're going to focus today on the bottom 4, taxes on income, gifts, generation skipping gifts, and taxes on wealth at death. The same strategies that help you reduce your gift and estate taxes also often reduce your income taxes or your family income taxes by shifting them to a lower tax bracket, whether that's in a different year or to a different individual. Why should you be concerned with generational wealth? Well, you can't take it with you at death. Your assets will be allocated between the government, individuals, and charity. A will is great, but must pass through probate. Probate is a legal process where your personal affairs are publicly settled in court. It's public, expensive, and time-consuming. Revocable trusts are preferred to own your real estate and non-retirement accounts because they are private. We're going to talk more about those in a little bit. I know many stories of how a lack of planning really wreaked havoc on estate planning. Assets that went to an ex-spouse, a deceased child, unintentionally bypassed grandchildren. One case where someone left an annuity to a trust outright, and the trustee did not distribute that money in the same tax year, resulting in a 6-figure tax bill that could have been greatly reduced by spreading the assets, distributing the assets in that year or spreading it over multiple years with appropriate planning. This also came with an $80,000 tax penalty for underpayment on top of the six-figure tax bill, all of which could have been completely avoided with appropriate planning, combining estate planning with financial planning. These are unintended consequences that can be avoided by ongoing beneficiary and estate planning reviews and document updates, as well as using financial advisors to work with the trustee, executor, and estate planning attorney. There is no need to have a chaotic, lengthy, expensive distribution of assets when you die, not to mention the chaos this inflicts on your heirs and loved ones. Celebrities are a treasure trove of information of what not to do with your estate planning. Prince, you might know who that is. Prince had no will or estate planning in place at his death in 2016. It took 6 years for his estate to be split between his 6 half-siblings. Would he have wanted them to inherit? Who knows? Don't know. He was against streaming his music. It's now being streamed. Lack of planning. His estate paid over $3 million in mostly avoidable probate costs and legal fees. Michael Jackson, another famous one, died in 2009. While he did write a will and he had a revocable trust, he neglected to title his assets in the name of the trust. That's known as funding the trust. Therefore, the trust was empty, didn't do anything. His estate, worth hundreds of millions of dollars, is being settled publicly. Also, his assets are subject to creditors since they had to pass through probate, which again, public, expensive, and lengthy. Had Jackson funded his trust, it would not have gone through probate. Anna Nicole Smith, I don't know if anyone remembers who that is. She was a model in the 1990s who married a billionaire, 89-year-old billionaire. I think her strategy was to inherit. She was like 23. She ended up inheriting nothing, zero, from the billionaire she married because they lived in a community property state. Don't worry about that, we don't live in one. And he created a new will after their marriage saying she should get nothing. Her financial advisor should have made her aware of that fact way in the beginning. I think she's also passed away, but in poverty. Larry King, you might remember him, a big guy on the TV. He was married to over 7 women over time, had 5 children. There was a divorce settlement pending at the time of his death. He had a handwritten will in 2019, leaving everything to his 5 kids. Problem is, 2 of them sadly passed away over the next 2 years, and then he passed in 2021. Now a court has to decide how to split the money that is not in trust for those 5 kids, and what's gonna happen to the 2 kids' share that were deceased. Will it go up to the siblings? Will it go down to their children? Who knows? Interestingly, that only applies to about $2 million worth of assets. He had reportedly had $140 million in trust, which we have no information on. That is because a revocable trust is private. That's why we like trusts, one of the many reasons. My suggestion, update your estate planning after life events. That's when we recommend that people go see Theo or someone like him to update their planning. Otherwise, courts may have to decide how your inheritance is dealt with if the documents don't address death and disability. Also, don't do what Aretha Franklin did. She had 5 kids, one of whom was special needs. She left multiple handwritten wills all around her house. One of them was found under the couch cushions, literally. And it wasn't discovered until after they started to probate the wills. So that was a mess because they had to figure out which will was going to take charge. And you don't want to leave assets to a special needs child outright, as that can blow any benefits they may otherwise be entitled to. You also don't want to do what she did and say, I'm leaving it to the other 4, you guys just take care of him. That was also not a good strategy. Also, a handwritten will in general, is not valid unless it follows state law, which is different in every state regarding signatures, witnesses, and probably other things that Theo knows and I don't. Wills are the safety net, not the primary planning tool. If you are a client of mine, you have probably heard me say that nothing should pass through the will because everything should be appropriately titled and have a beneficiary stated. The most valuable thing your financial advisor can do for you is making sure you get to an estate planning attorney, get the documents you need, and make sure they're properly implemented. So many celebrities meant well, but didn't do this. These people could afford the best advisors. Some created the documents, they just didn't implement. As a financial advisor, we make sure that our clients implement their planning. It does beg the question, though, who is their financial advisor? A real life example of a client who passed away, they owed a creditors $20,000. Their assets passed immediately the next day via beneficiary designation. The creditors received nothing. Appropriate planning, you can do lots of things. We're going to talk about wealth transfer taxes at death, known as the estate tax, because the gift and generation skipping tax are tied to the estate tax exemption. In one unified credit, currently about $14 million if you're single and $28 million if you're married, but that's scheduled to drop in half January 1st, 2026, next year. Will you even have a taxable estate? You need to look at what you own minus what you owe, and several states have much lower limits than the federal exemption. So often when we're doing planning now, we're looking at the different state exemptions, which you can see on the slide here. Unused federal exemptions are portable, meaning that if you don't use it, whatever is unused can pass to your spouse to be used by your spouse, but many states don't offer that same portability. For example, Massachusetts does not. I'm not sure about the other New England states. I'm sure Theo is aware. And also important to note that estate tax is not due until after you're gone, so you might say, I don't care, it's a kid's problem. But it could be a problem for your heirs and for, let's say, you if your parents pass away and you inherit. So will you have a taxable estate? Well, what's the estate tax limit going to be the year you die? Anybody know what year that's going to be? Congress doesn't know what the limit will be. I certainly don't know. If you believe Bitcoin is going to the moon and you own Bitcoin, you should be concerned about estate and gift taxes. If you own a small business, you should be concerned about estate and gift taxes.
Yes. So by a show of hands, outside of what you've heard here this evening with regard to the estate or death tax, how many of us are familiar with the concept of the estate tax? Okay, so we're doing very well here this evening. So to Jen's point, we don't know if you're going to have a taxable estate when you pass on, right? So your taxable estate is quite broad. Essentially, anything you own, anything you control gets brought into your estate, okay? Your taxable estate is also going to include any jointly held assets that you own with the non-spouse. So the full value of those joint assets owned with the non-spouse, unless we can prove or show that the other joint owner somehow contributed to the cash account, the stock account, the acquisition of real estate, etc. We're going to talk about gifting here this evening. Gifting is a very powerful tool or strategy because essentially when you make gifts, okay, any appreciation on those gifts is going to pass outside of your taxable estate. Annual exclusion gifts, presently $19,000 a year, right? I can give to anyone up to $19,000. I don't have to report those gifts to the IRS. The second I cross that threshold, I have to file a gift tax return with the IRS, and those taxable gifts get brought back in. So if the gross estate is over the threshold, the executor must file an estate tax return within 9 months. The estate is going to be taxed on the net value of the assets, right? So we can take away or deduct certain expenses of admin, funeral expenses, CPA fees, any debts the decedent may have owned. So we can kind of chip away at the taxable estate to try to reduce how much taxes we're going to pay. The effective tax rate right now is 40% on the amount over the threshold. So for those of us who have taxable estates, it's of critical importance to come up or to do comprehensive estate planning, right? To fund your revocable trusts. You can have the best drafted trust, but if you don't place your assets into the trust, then we're just partly there. We're not all the way there, right? And then for beneficiary designated assets, retirement accounts, annuities, life insurance, oftentimes the designation of beneficiaries for those assets is overlooked, but it shouldn't be because that's really important. And we want to make sure that those assets are distributed properly in coordination with the overall estate plan. I talked about certain deductions that we can take on the federal estate tax return. charitable gifts or bequests are deductible, right? So if you have a taxable estate, a real simple way to reduce the size of your taxable estate is to make charitable gifts or contributions. And a really nice way to do that is if you have tax-deferred accounts, 401ks, IRAs, 403bs, when you name a charity or charities as the ultimate beneficiaries, A, we're reducing the taxable estate, and then B, the charitable organization is not going to pay income taxes on those gifts. So it's a win-win all around, okay? To Jen's point, you do want to review your plan every 3 to 5 years or sooner if there's a major life event. Just a couple of real quick scenarios or things that I've seen out there in the last 20 years. When I talk with clients, oftentimes for whatever reason, when I meet with clients, they don't view or see life insurance as an asset. I'm not quite sure why, but they don't. But when I'm meeting with clients and I'm trying to nail down or figure out, okay, are we going to have a potential estate tax issue here? I always include life insurance, right? Now, one very easy way to deal with life insurance where it makes sense, you could do an irrevocable life insurance trust, have the trust own the policy, and the same trust is being named as the beneficiary of the policy, thereby those proceeds pass outside of your taxable estate. Another thing that comes across my desk from time to time is, we're in New Hampshire, right? But we border Massachusetts, state level estate tax, Maine, Vermont. So I'm also licensed to practice law in Massachusetts, so I'm very familiar with the estate tax arrangement in Massachusetts. So for those of us who are New Hampshire residents, but let's say we own a second home on the Cape, Falmouth, wherever, right? Even as a non-resident to Massachusetts, when the homeowner passes on, if his or her taxable estate, if all of the assets exceed the mass threshold, which is right now just $2 million, there's going to be some mass estate tax liability, okay? And there are ways to get around that. For example, what I do for certain clients is we can establish an LLC, a limited liability company, to own the real estate, and by doing that, I might be splitting hairs, but we're changing the nature of the real estate interest from real estate to what's called intangible personal property, and the Commonwealth can only tax, as it relates to non-residents, real estate or personal property that's physically located in Massachusetts. So putting mass real estate in an LLC, if you're a New Hampshire resident, we can avoid estate taxation in Massachusetts.
Excellent point. I did allude to it, but I want to make sure everyone is aware. If you live in Massachusetts, there is now a $2 million exemption. So while people might say, I'll never get to 14 million, 28 million, whatever, A, we don't know what Congress is going to reduce that to, and B, a lot of the state limits are a lot lower. Of course, not New Hampshire, but the other surrounding states. So you might as well plan, because there is no way to know today whether or not you'll have a taxable estate. Almost all tax reduction strategies can be summed up as moving income to different years, to different people or entities, or moving assets to different types of accounts. I've spoken and written a lot on ways to reduce your income taxes before and during retirement, and you can access that information on our website /insights, linked at the end of the slides. We're going to focus today on reducing gift, GST, and estate taxes, which also usually reduces your income taxes. Estate tax revenues are a rounding error on the federal budget, and gift tax revenues are negligible, that tiny little sliver at the top. Is this because nobody's giving gifts to their family, or is this because people aren't filing gift tax returns? I'm guessing the latter. We're going to try to educate. It's mostly because of lack of knowledge. People don't realize. They say, I helped my kid buy a house, gave him $50,000. They don't realize that that's potentially a taxable gift. Do I need to plan if I won't have a taxable estate? Most of my clients' families struggled with money. These families have worked hard and built something they didn't have when they were growing up. Most of my clients did not inherit money, they built their wealth. It is important to pass on your values and education as to what money can and cannot do for you along with the money. I've seen adult children of families who didn't do this, who struggled their whole life with money. You probably know people like that. Mainly because they were never taught what it was like to not have any money. It's very difficult to live in affluence with a healthy relationship with money until you've earned money yourself. This is why inherited money is usually gone by the third generation. An inheritance should be accompanied by personal finance education appropriate to the amount of the inheritance. People with money know that money cannot buy happiness, but our kids don't know that unless we teach them or they live it. Plan so that your hard-earned money goes where you want it to go. Avoid probate, which is expensive, time-consuming, and public, and teach your kids how to live with affluence, how to still have a work ethic, but also know that they have resources. An annual gifting plan under the gift tax limits that Theo was mentioning can help with this, as those relatively small amounts, but can be very large amounts to the recipient, are distributed over time. Gifting is a way to avoid estate taxes. In 1932, the government cracked down on rich people giving their money away before death with this tax. Most of lifetime gift tax accounting is filing gift tax returns to track your lifetime taxable gifts in excess of the annual exemptions. Note, when we talk about gifting, we're usually referring to non-qualified, non-retirement accounts. That's money outside of an IRA, 401k, or other type of retirement plan. As Theo mentioned, everyone can give $19,000 per year per person to anyone they want. There's lots of different types of gifts, which we're going to go over on the next slide. If you're married, you can do something called gift splitting, which means one person can give the gift, but it can each person, you can assign $19,000 to each member of a couple. But in order to gift split, you must file a gift tax return. So for example, if I give my daughter $50,000 for a wedding, and I can use $19,000 of my exclusion, $19,000 of my spouse's exclusion, and then I could allocate $12,000 to the person she's marrying and technically have it all be covered by the exclusion. I would still have to file a gift tax return, but I would not have to use any of my lifetime exemption because it would all be exempt. There's also an unlimited exemption, which you may have heard of, for payments made for medical expenses or education expenses, but both of those expenses must be paid directly to the facility to be exempt. And the education rule is tuition only. It is not room and board. It is not books. It is not anything other than tuition, unlimited. No gift tax is actually paid until you exceed the lifetime gift tax cap, which is currently the same as the estate tax exemption of the same almost $14 million, slightly under, for 2025. Gifts in excess of that, similar to the estate tax, are taxed at 40%, but you don't need to pay until after death. So again, you could say, not my problem, unless you're inheriting on the inheriting end, and or you want to plan so your heirs don't need to deal with this issue. There is an example I saw online where a doctor he wanted to pay for his mother's nursing home. So he gave her a bunch of cash and she deposited it in her bank account and then paid the nursing home. The IRS ended up auditing her for the cash deposits and called those all income, which they will do if they look at your bank statements and see unscheduled deposits that you can't prove. When of course they were not income, they were gifts, but he could have completely avoided the gift tax had he just paid the nursing home directly. 2 lessons there. Don't deposit large sums of cash like that, and especially don't give it as gifts. And if you're going to pay someone's medical bills or tuition, pay directly to the facility. Gifts to spouses are unlimited. No rules, assuming they're both U.S. citizens. If they're not U.S. citizens, then there are rules. Be very careful. If you know people that are not U.S. citizens that are married, definitely want to see an estate planning attorney on that. Annual gifting plans are the easiest and simplest way to pass on wealth tax-free to others if started early enough in your life. And early enough can be 60s. I mean, we're not talking, 20s or 30s or anything, when everyone's still working and trying to save. Gifts within 3 years of death are pulled back into your estate, going back to Theo's calculation of estate tax. And when he mentioned life insurance, he's talking about life insurance proceeds. A lot of people don't realize, they think life insurance proceeds are tax exempt. They are income tax exempt. They are brought back into your estate at your death, unless, as he mentioned, they are held in a separate irrevocable life insurance trust. There's a lot of complicated trust structures that are sold to wealthy individuals to proposedly save gift and estate taxes. In my experience, those aren't always necessary for most people. A simple annual gifting strategy can accomplish a lot if started early enough. These are examples of gifts. If you give cash, I don't know if you can see this tiny little print, but if you give cash to someone, or if you give stuff, you help buy someone a car. Services, you pay for a wedding for your kid. You're limited by the $19,000 per person per year. But then again, you can double that if you're married, and you can quadruple that if you spread it between the husband and wife who's getting married. Property, helping your kids buy a house. Contributions to 529 plans or investment accounts. Those are also considered gifts, and you have to factor that in if you're filling up your child's or grandchild's 529 with any other gifts that you're giving them. Education, medical, we talked about, and payment of life insurance premiums held in trust. When you do set up that irrevocable life insurance trust to hold your life insurance policy, the payment of those premiums are considered to be the beneficiary's asset, hence a gift. Here are some examples of ways to transfer your assets to your heirs in a tax-efficient manner. Fund your working heirs' Roth IRAs. I've done this for folks who've done this for their grandchildren, assuming their grandchildren have just started working, and so they're under the income limits for Roths, but they've made at least the $7,000. That's a good choice. Paying off grandchildren's student loans in less than $19,000 increments per year. It's another good way to do it. Obviously factoring in gift splitting sometimes. And this works really well if your grandchildren are responsible with money. Obviously, if you give money to them outright, that money is subject to their creditors, divorce, bankruptcy, and lawsuits. You have to consider that. And again, pay their medical expenses directly and their tuition only directly. Yeah.
So gift splitting, just a quick follow-up on that. In order to take advantage of gift splitting, the spouses must be married under state law, and both of them must be U.S. citizens. Then one other quick follow-up when it comes to gifting. The gifting of business interests can be a very effective way to give away a business interest, because if you're just giving away a portion of your business, we can do what's called a discount valuation. So even though, and I'm going to make this up, very simple numbers. Let's say the business is worth $100,000, but you're giving away 33% interest in the business. Well, it's not dollar for dollar. We can reduce that. We get a business valuation. We can reduce that number. It's a real effective way to give away business interests. So, will I pay gift taxes? The short answer for most people is no, right? Because we have this very large unified credit. It's the estate gift exemption, presently $13.99 million. So in order for the maker, the donor of a gift or gifts to actually pay gift taxes, that person must give away, excuse me, my voice keeps breaking up, must give away in life in excess of $13.99 million. So not likely. In the context of gifting, if we're under that threshold, neither the maker of the gift nor the gift recipient is going to pay any gift taxes, okay? So a quick example, if I give my daughter $100,000 tomorrow, okay, I'm not paying gift taxes, neither is she as the recipient. Excuse me. But by April 15th of next year, I must file a gift tax return with the IRS. I report the entire gift to the IRS. The first $19,000, that's my annual gift tax exclusion. The next $81,000, essentially what I've done is I'm chipping away at that $13.99 million exemption. So if I pass on, let's call it $14 million less $81,000 is what I have remaining. So still a fairly large number, okay? The other thing to be mindful of when we're talking about giving assets away is cost basis, right? If I'm giving away cash, well, the basis in a dollar is a dollar. Cash is simple, right? But if I'm giving away, let's say, stock shares that have really appreciated in value, okay? If I'm giving those shares to one of my children, for example, whatever my cost basis is, whatever I paid for those same shares, well, my child is essentially going to inherit my cost basis. It's called carryover cost basis. So when you're thinking of giving away assets, you should put some careful consideration into, does it make sense to give away this asset where my basis is quite low, right? In other words, if my child sells this asset, my daughter's going to pay capital gains taxes, right? Where on the other hand, based on today's income tax laws, if I continue to hold those stock shares until the time that I pass on, my cost basis is going to be reset to whatever those same shares are worth on the day of my passing. So it's a consideration. It's not the end all be all, but it's just something to be mindful of. I'm up? Okay. So we've talked about the estate tax, okay? There's another onerous tax that you need to be aware of called the generation skipping transfer tax. So that's a federal tax on transfers of assets or property from a grandparent to a grandchild or to individuals that are more than one generation below the transfer or the person who's making that gift. In addition, this tax would apply when someone is making a gift to someone who is 37 and a half years younger, more than 37 and a half years younger than the person making the gift. Okay? Now, these GST tax rules apply regardless of whether we're talking about a direct gift, an outright gift to a grandchild, or perhaps a gift into a trust. The same rules apply. So this tax was introduced back in '96, and it was really implemented to prevent what the IRS at that time perceived to be, wealthy families essentially avoiding estate taxes upon the death of each generation. So the IRS wanted to be sure that where possible, they were collecting those estate or death taxes. Now, when the GST tax is applicable, okay, it's the GST tax rate is equal to the highest federal gift and estate tax, presently 40%. I want to go over a few concepts with you, GST concepts with you. Direct skips, I've sort of alluded to this already. When assets are transferred from an individual, grandparent, let's say, to a skip person, the grandchild, either outright or in trust, for a direct skip, the transfer or the grandparent, in my example, or their estate pays the tax unless the grandparent applies or allocates GST through a gift tax return where the executor does the same thing. Okay? Taxable distribution. So I'll give you an example there. Let's say that an irrevocable trust has been established and a distribution of principal, of income or principal is made by the trustee to a skip person. For example, the trust was set up for Sally and her children by Sally's mother. Trustee makes a distribution to Sally's children during Sally's lifetime. If Sally's mother did not apply her GST exemption to the assets that she transferred to the trust, this would be considered to be a taxable distribution, and the actual GST transfer tax would be paid by the recipient when that distribution actually occurs. The other concept to be mindful of is a taxable termination. So we're talking about an irrevocable trust that's terminating, and when that trust actually terminates, there are no other non-skip beneficiaries of the trust. In that case, the trustee is responsible for paying the GST transfer tax when that termination occurs. Okay. So be mindful of the fact that when a grandparent, for example, is making a gift into a trust for the benefit of a grandchild, we have to allocate GST to those transfers, okay? To the initial transfer and then to subsequent transfers as well. And we can do that essentially automatically by filing a gift tax return, but there's more to it than that, right? Because in subsequent years, if, for example, funds are contributed or gifted into a life insurance trust, and that's a GST trust, well, in a perfect world, the accountant, the tax preparer, the attorney, the estate attorney is filing gift tax returns with the IRS so we can track those GST allocations. We know exactly how much the maker of these gifts, how much GST that person has used. Without those returns, sometimes it's next to impossible to recreate those numbers, okay? I want to give you an example just to show you how effective this can be. So Paul sets up an irrevocable trust in 2024. He funds it with $10 million. It's a trust for the benefit of his grandchildren and future generations. Okay? Let's assume for my example that this trust subsequently grows to $20 million. So the value of the trust actually doubles. So that's huge because now the entire $20 million, when that ultimately passes to the grandkids, it's all going to pass GST tax free. So Paul, in my example, allocated $10 million, but now the full $20 million is going to pass estate tax free. So that's a really important concept. So in terms of definitions, I've talked about the actual GST tax. We've talked about skip people, if you will. Could be a grandchild, further remote descendant, someone who's more than 37 and a half years younger than the person actually making the gift. So on a very, very high level, those are some of the important terms or definitions regarding the GST tax. Sorry.
529s. Does anyone know what a 529 is? A few people. Good. 529 is a tax-free way of paying for all college expenses. We suggest filling 529s using your annual gift tax exclusion for your children, grandchildren, or whatnot, because they are gift tax and GST tax free, because you do still have to worry about GST with 529s if you set one up for 2 generations below you. But generally, if you set up 529s for your children and you have it in an aggressive investment allocation or an age-based allocation, that's going to grow tax-free. Whatever is left over after paying for all college expenses, not just tuition, but everything related to college, can just continue growing forever. There's no minimum required distributions, no reason to take it out necessarily. Superfunding is a special gift tax rule that allows you to put in up to 5 years of contributions all in the first year. It uses up your annual exclusion of $19,000 a year, but you could theoretically put in $19,000 times 5 years, times if you're married, the two of you, that's $190,000 to supercharge your child's 529. I'll say child, and you'll figure out why in a second. In order to claim the superfunding, you must file a gift tax return. The gifts given is evenly split over the 5 years. So if you put in $100,000, divide that by 5, the IRS assumes that's $20,000 per year. And so you'd use $19,000 of your exclusion in each of the years, and you'd have $1,000 left over, which you could either gift split to get rid of or just use your lifetime exemption. There are problems with superfunding, meaning the tracking of it is annoying. All the clients I have who've superfunded, like they don't remember, oh, now I want to give next year $19,000 to my kid for whatever. Well, you can't, because remember, we did this gift, so you've used up X dollars of your exemption, so now you have to have a spreadsheet and track the whole thing, and so it gets a little complicated, and people generally forget. And they have to file gift tax returns each year to keep track of everything. Best practice for 529s for heirs is don't set up, some people, I've seen this on social media, don't take tax advice from social media, hot tip. They will set up a 529 plan for themselves saying, my child's gonna be born in 3 months, or I'll have a kid eventually, so I'm gonna set a 529 plan up for my kid now, and then I'll just transfer the balance to them when they're born. Well, if enough years go by and it grows and it's more than $19,000, when you transfer that 529 plan to your child, the balance is subject to the gift tax and the $19,000. So it might have grown to more than that. If it's less than that, who cares? But if it's more than that, now you have a problem. Generally, set up 529s for your children, and then when your children have children, they can transfer any unused balance to their child. And because in a special fluke of 529s, I swear they must have been developed by members of Congress that had excess funds for education. If you're waiting for a grandchild to be born and you change the beneficiary in the 529 to you or your grandchild, GST will apply on the balance transferred. But because the beneficiary owns the account for estate and gift tax purposes, as long as the accounts are passed down to children GST will not apply. It avoids GST forever. So children to children and their children to their children, and it grows income tax free if used for education. But in theory, if you have enough, if people procreate, you can leave a very large legacy to your children, grandchildren, and future generations. How much will college cost? Do you want a super fund? How many years do you have to save? What will your resources be when they're in college? Will your grandparents be contributing? All of this factors into whether or not you should superfund. I'm not really a big fan of superfunding because at $19,000 a year, if you start when the child is born, you can really put in a ton. And grandparents can also contribute as well. So the grandparents can also contribute the $19,000. And again, that counts for a gift tax exemption and a GST exemption. So you can build these things up pretty high. So which gets us to Legacy 529s, which is where I was going with this, which is in the event the 529 plan beneficiary is changed to an individual who is not an eligible family member, something as these are all the eligible family members listed here. Any change of beneficiary here will be treated as taking a distribution of the entire account, so please don't do that. Only change the beneficiary to a family member. It's pretty liberal, all the different choices here. But if you take it out, if it's treated as a distribution, that ordinary income tax will apply to all the earnings, plus a 10% penalty. But this list gives you tons of flexibility to pass income tax-free and tax-free wealth on to future generations. As long as the 529 plan beneficiary is changed to a sibling or older generation, which must be a family member per the prior slide, gift tax does not apply, a little quirk of the law. But if you change the beneficiary to a member of a younger generation, then that is a taxable gift from the old beneficiary to the new one, not the old owner, the old beneficiary to the new one. And a gift tax return should be filed to use a portion of their lifetime unified credit, but no GST should apply. And because this is your children, in theory, your children don't have as big as a taxable estate as you do. That's the theory, and you can keep going. And as the money keeps getting split between multiple children and multiple children of their children, it's smaller and smaller. But it would use any change of beneficiary on a 529 account should involve a gift tax return if the balance is over $19,000, or $38,000 if you're married. Start the plan as young as possible and contribute the annual exclusion to your grandchild or great-grandchild. Set a plan up for each of your children. Let them pass the balance to their children. And there is some information online that people expect the IRS to come out with regulations that override this, because this seems like a little bit of a loophole to pass assets on to future generations. Types of trusts. We talked already about revocable trusts, and Theo was talking about irrevocable trusts. The difference is a revocable trust is just like you owning the money. It's in your social security number, your name, your address. You can do anything with it. Everything is titled in the name of the trust. You are the trustee, but effectively it's taxed to you. It's not really a separate entity. And it can be changed at any time. You can revoke it at any time. A revocable trust is great for incapacity planning because it really protects you. If something happens to you, the trustee can take over. It's a lot easier for somebody to use a successor trustee designation than it is a durable power of attorney. A lot of banks won't accept the durable power of attorney, even though they're legally obligated to. It's just a thing that is practically a problem. So trusts are great for that. Revocable trusts automatically become irrevocable at your death, so they turn into irrevocable trusts. So it's always odd to have the such and such revocable trust for somebody that's deceased. They do not provide liability protection for you or Medicaid protection or anything like that, but they can protect your hard-earned assets from your beneficiaries' creditors once you've passed on. Irrevocable trusts, like the name says, you can't really change them. The terms are what they are, so be very careful when setting these up. When putting assets inside an irrevocable trust, you are, as Theo mentioned, removing the future appreciation from your estate, which is a reason some people do this. So we often have people, there's lots of fun things you can do when the market dips. Market dips are actually great planning opportunities. One of the things you can do is move some assets that are invested in stocks into an irrevocable trust for your grandchild at a very low gift tax, using an amount of your gift tax exemption, but a low amount. And then when the markets recover, as they always do, it grows, zooms up, and you have transferred a ton of wealth to the next generations with low gift and generation skipping taxes. And again, most gifting is referring to, again, non-qualified funds, not retirement accounts. It's very difficult to gift retirement plan accounts due to tax reasons. Theo.
So is the gift a completed gift? Essentially, we need intent to make a gift, delivery, and the recipient needs to accept that gift, right? How does the IRS know that you've made a gift? Well, we've talked about it tonight. You're required to file gift tax returns if you exceed the present $19,000 threshold, the gift tax exclusion. As we've briefly discussed, only a present interest gift can qualify for the annual gift tax exclusion. If we're talking future interest gifts, typically what we're talking about is a gift to an irrevocable trust, and then the beneficiary of that trust doesn't have the current or immediate right to withdraw the contribution that has been made. So in the case of a future interest gift, that would count against the donor's lifetime exemption, that really large exemption, right? That's why it's important with life insurance trusts to give to the beneficiaries this withdrawal right when contributions are actually made. We give the withdrawal right, beneficiary doesn't exercise that right, trustee pays the premiums. When that happens, it's a present interest gift, okay? Be mindful of the fact that if you're making a gift to a life insurance trust, okay, each beneficiary of that trust will have a right to withdraw his or her pro rata portion of the contribution. When you're thinking about whether or not you actually have to file a gift tax return, you also need to consider any outside gifts that you have made. Because when you couple the gifts made to the life insurance trust and any outside gifts, you might be over the threshold. Okay. And also in this context, when we're talking about this notice that has to be given to the beneficiaries of a life insurance trust, commonly called the crummy notice based on an IRS case, the crummy notice doesn't apply to the GST. Okay, so we still have to file the gift tax return and make that election under the return. Okay. So we've talked briefly about who's a skip person, transfer from a grandparent to a grandchild, or to some other individuals who's more than 37 and a half years younger than the transfer, or who's not a skip person. Let's talk briefly about what's called the move-up rule. Okay, so the IRS regulations provide that any individual who dies no later than 90 days after a transfer occurs by reason of death is treated as having predeceased the transferor. So just to give you an example, if a child passes on within 90 days of his or her parent, then he or she will be treated as predeceasing the parent, so that the children of that deceased child move up to the child's generation. Okay? And when that move up happens, there are no GST tax complications or ramifications. Now, the move up rule only applies to lineal descendants, but if there are none, it could theoretically apply to grandnephews and grandnieces. Okay, inadvertent GST gifts. We've talked about this already in a roundabout sort of way. So again, brief example, grandparent establishes an irrevocable trust that benefits the child and the grandchild. When the child dies, this is a gift to a grandchild which is subject to GST. Again, it's called the taxable termination, right? The solution, the fix is really simple. When the trust is formed and funded, it's imperative that a gift tax return be filed so we can allocate GST That way when the child actually passes on, and now we're benefiting the grandchild, no one's paying any GST taxes in that example. But again, super important to file those gift tax returns.
The overall takeaway tonight, file the gift tax returns. I don't know if you think what we're getting to. All these tools can work together. These are a bunch of simple planning solutions to pass wealth down. You don't need complicated solutions or strategies until all of these have been exhausted. Beneficiary designation. Your IRA is a tax bomb. You can use your IRA beneficiary to fulfill your charitable goals, as no one will pay taxes on that money. That is, if you haven't used it already, to pay your own long-term care expenses tax-free. Use beneficiary designations to allocate specific assets to specific types of beneficiaries. For example, IRAs, leave them to charity to avoid taxes completely. Roth IRAs to people for tax-free growth for 10 years. Beneficiary designations can avoid Medicaid look-back and gift taxes. I had a client who were moved into a continuing care retirement community, a CCRC. One of them was terminally ill, sadly. Because of that, we were able to change beneficiaries to the adult children. As long as the terminally ill person, you expect to live for about a year, at least a year, those assets can be held aside and invested for the surviving parent, but they legally belong to the children at the death of the ill spouse, and that has avoided Medicaid on half of their assets, essentially. There's no look back anymore, and there's no gift tax or GST tax does not apply to inheritances. To do this, to be practical, you don't want to be greedy and put all the assets in the dying spouse's name. That's not something the IRS will like. But in general, or the CCRC for that matter, but in general, we tend to equalize the gifts to be able to do that. And also there's a risk that one of the children will run off with the money, but that tends to be lower when you're working with other advisors and who are managing the money, saying this is really for the spouse, don't run off with the money. But it is possible. Consider leaving your IRA to a testimonial irrevocable trust. That just means one created by your will, doesn't exist until you pass, for your grandchildren. Because that one doesn't exist until your death, the gift tax, again, and Medicaid look back and GST do not apply. Asset titling. Many people create trusts, but then never do the work of changing the bank accounts or assets so they're titled in the name of the trust, a la Michael Jackson. Make sure your retirement accounts are titled in the name of your revocable trust. Non-retirement, not retirement. Gene, I'm surprised you didn't correct me on that one. Make sure your homes are in trust. Make sure you have a state-specific trust for each state you own a home in. Asset location. Highly appreciating stock should be held by your Roth IRA. For example, if you know anyone who's starting up a company, startup company stock, a la, Peter Thiel, who started many companies and put next to nothing and made his little Roth IRA contributions and then bought the company stock, and now it's worth billions. Literally, imagine having billions in a Roth IRA. Asset allocation. You build wealth by owning stocks. Make sure your assets are appropriately invested in a diversified portfolio, including stocks. You can see my retirement seminar online for more details and a rant on that. To maximize your wealth transfer and minimize income taxes. Use annual contributions or gifts to 529s, HSAs, and Roth IRAs for you and your heirs to build tax-free assets. Pair this with investing these accounts, mostly in stocks, for growth. To supercharge those accounts. Incapacity is much more common than death. Use revocable trusts, durable powers of attorneys, and healthcare power of attorneys. It's really important to have you and your children see an estate planning attorney. That's another thing, another good gift. I just met with a client today and who's going to pay for their 3 children to get their estate planning done because it's under the limit and will help them and their children immensely. Irrevocable trusts benefiting the same generation to avoid these taxable termination issues that Theo was talking about and some of these more complicated items. When you set up an irrevocable trust, you can do one just for your grandchildren, and anytime you're putting money in that, Theo can file the gift tax return and allocate GST exemption to that trust, and all of that money and all of its growth will be GST exempt. But generally, you want to keep those generation pure, if you will. Beware of old estate planning. Currently, most people are only subject to state estate taxes because the Massachusetts limit of 2 million, or I'll get it wrong, but Rhode Island's 1.78 million, and Vermont is that the 5 million? 5 million? So those state estate taxes are what most people today are going to be covered by. But when the limit drops January 1st, 7 million instead of 14 million is a lot easier to hit. And who knows what it'll be in the future? I don't know. Beware that sometimes the state estate tax is avoided. For example, Massachusetts, with a low limit of $2 million, you want to set up a trust structure and put your assets into this bypass trust. And then the bypass trust will bypass the surviving spouse's estate at death. But because it bypasses their estate, it also doesn't get a step up in basis at the second death. And therefore, the capital gains taxes on those assets, federal and state, can be much larger than the Massachusetts estate taxes saved. I've seen this several times, and so sometimes what we end up doing, old estate planning, or somebody who died a long time ago in the spouse, and there's a lot of years between the first and second spouse's death. That's where sometimes you have to watch that you might want to empty that bypass trust. The old rule was, don't ever touch those assets. They're going to pass to the kids estate tax free. Well, when the estate tax is less than the capital gains tax, that's not necessarily wise. So the bottom line is, old estate planning can bite you, and all of this is overwhelming and complicated for everybody. So make sure you get to the estate planning attorney. That's why estate planning is just so very, very important. Do the basics. Make the most of your annual exclusion to multiple individuals each year. They do not have to be relatives. You can give money to anybody you want if you're giving outright. And again, nothing should be left to pass through your will. Your will is an emergency safety net, but anything left to pass through your will is public, expensive, and lengthy in time to dispose of. Your will is necessary to be the safety net and also to name the guardians of any minor children. And special needs trusts, another just quick comment I mentioned earlier, but don't leave assets outright to individuals who may qualify for public assistance now or in the future. Yep.
So legacy trusts for grandchildren, typically what we're talking about is some type of irrevocable trust, generally speaking. The trust is meant to provide for the well-being of the grandchild, his or her children, and so on and so forth. Now, these trusts can be highly customized. It's typical that if we're doing a legacy trust for a grandchild, that the trustee is going to hold the trust assets in trust for the grandchild's lifetime. So a lifetime trust, discretionary trust, can be used for anything really: health, education, maintenance, support. So these trusts are highly customizable. Now, if the trust has all the bells and whistles, the trust theoretically can protect the assets from the creditors of the grandchild, a divorcing spouse, a lawsuit, bankruptcy, but the trust needs to be set up correctly in that sense. Now, the beneficial interest in the trust, it's typical to have a gifting trust or a legacy trust for a grandchild, right? In New Hampshire, however, where it makes sense, where it fits, we can do a dynastic type trust, a perpetual type trust that theoretically can benefit multiple generations at the same time. And with the dynastic type trust, theoretically, that trust can carry on from generation to generation until such time as that trust becomes too small, it simply becomes too expensive or costly to maintain that trust, right? There's a cost related to irrevocable trusts, legal fees, CPA fees, taxes. So there's a cost involved. So this sort of trust can stay in existence until it either becomes too small or we run out of beneficiaries, right? But New Hampshire is one of those few states where we can do perpetual trusts. In certain other states, an irrevocable trust must terminate at some fixed time down the road, okay? Income taxation for irrevocable trusts, very, very important. If the trustee retains the income, the interest, the dividends, then the trust is paying taxes, okay? Why is that important? It's important because if at any calendar year a trust earns $15,650.01 or more, and the trustee is retaining that income, now we're hitting the top tax rate of 37%. Now, in certain situations, it makes sense to retain or hold the income, but in other cases, not so much. By comparison, however, if a trustee is distributing the net income to a beneficiary every year, let's say, that beneficiary will receive a K-1, and that beneficiary will need to pick up the tax liability on his or her own tax return. Theoretically, lower tax rate, okay? So in certain situations, it makes sense to have an income distribution plan so we can minimize income taxes. Now, if the beneficiary is a minor, it's a little more complicated. Passive income, unearned income, interest from irrevocable trust, they're taxed at certain tiers by the IRS. And once we cross a certain threshold, those distributions are going to be taxed at the parent's tax rate. Okay.
Trust beneficiaries are often in a lower tax rate than their parents or grandparents. By distributing the trust income to them, you are greatly reducing the taxes paid on the funds, and that's because, as Theo mentioned, the tax brackets are compressed for trusts. So if you put money into an irrevocable trust, it is going to, it's going to pay taxes on that income. It's going to pay taxes at a very high rate. So it is something to factor in. Here's an example. So let's say you have an irrevocable trust. It only has investments. It has earned $30,000 of income, $10,000 of interest income, and $20,000 of qualified dividends. It's important to note, capital gains are usually taxed to the trust itself. Usually you can't avoid that. There are ways to avoid that if you start the very first year. You do the trust tax return, that there are distributions. You can distribute capital gains, but most of the time you'll see capital gains taxed to the trust. So this $30,000 is the trust income. The trust will pay $6,195 in taxes, almost $6,200 on that 30 grand. If instead that income was passed to the beneficiary, let's pretend there is one beneficiary, and this one beneficiary earns $100,000 in wages at their W-2 job, then you add that $30,000 that they were given. You have to actually give them the money, distribute the money to them. They're going to pay an additional $2,200 on that same taxes. So again, for low-income beneficiaries, it makes sense to distribute the income. We do this a lot with grandchildren trusts, and one way we distribute the income to minors is we distribute it right into their 529 plan. So just another way to get it to reduce the taxes on the trust, and it'll be taxed at their parents' rate because it's unearned income. But if their parents are in a low tax bracket and then it grows tax-free in the 529, it's sort of win-win. So the difference is a whopping 64%. You saved almost $4,000 by distributing that income. So we often work with clients to make sure that if they do have irrevocable trusts, should we distribute the income? What are all the pros and the cons, the tax cost? Does it make sense? The specific fact pattern will dictate whether or not you actually do the distribution. Always do your tax planning. If your financial advisor is not doing tax planning, look for one with a CPA or an enrolled agent who can.
So disadvantages to distributing trust income. So in certain situations, it doesn't make sense to have the trustee distribute the income to the beneficiary, right? So Jen alluded to this, but if we have a beneficiary who's receiving means-tested public benefits, if we're distributing income directly to that beneficiary, now we're jeopardizing continued eligibility for public benefits. So I know that Jen has briefly talked about special needs trusts. I focus a part of my practice on special needs trust planning. Just as a brief aside, as a father to a child with severe disabilities, it's an area of the law that I'm very passionate about. So Jen mentioned this. Oftentimes I meet with clients and they're afraid to leave assets to a child with disabilities because, again, they don't want to jeopardize public benefits. So they say to themselves, I'm going to leave the share intended for that child to my other children with the hope and expectation that my other children will care for their sibling. That situation, that arrangement is wrought with peril. The child who's being trusted with the money could pass away, could get sued, could get divorced, might lose interest. In the case of a marriage, when there's a spouse involved, it really complicates things. Just really quickly, there's another way to handle this, right? We can safely put assets into trust for someone who's deemed to be disabled, who's receiving public benefits. That's a special needs trust. If that trust is being administered properly and correctly, that trust is going to have zero bearing on public benefits. So that's the preferred way to handle that. So be mindful of the fact that outside of the special needs trust context, once income or principal leaves a trust, it's outside of the trustee's control at that point. We have no control what happens thereafter. So if a distribution is made to beneficiary who's being sued, getting divorced, etc., it's very possible that those disbursements will be subject to attachment or reach by the other party. So oftentimes, in the case of whether we're talking a child with a disability, or if we're worried about a spendthrift beneficiary, someone who might waste this income distribution, oftentimes what I'm telling the trustee to do is, why don't we just pay the vendor directly? If the beneficiary has a need, a new bed, a car, whatever the case might be, right? Let's just pay the vendor directly. That way there, we're not putting the money, the distribution, directly into the beneficiary's hands. Okay. So, costs. When I meet with clients at the firm, I usually don't lead the discussion by talking about legal fees or costs unless I'm asked at the outset. I usually save that for the very end, okay? And once I know exactly what we're doing for a client, I can quote a range at that point. So, from a legal fee perspective, to do a fairly comprehensive estate plan, revocable trust, wills, financial powers of attorney, medical powers of attorney, HIPAA authorizations, you're probably looking at about $2,000, okay? To form or establish an irrevocable trust for the benefit of a grandchild, probably about $2,000, okay? Annual gift tax returns, and this really is dependent on the complexity of those returns. Certain returns are super simple to pull together, but on average, probably about $1,000 to pull the returns together. Income tax returns for grandkids, about $400 a piece there, okay? So the total cost, you have these one-time costs of about $6,000, and then 10 years of these annual costs that come out to $2,600 a year. So for purposes of this example, $32,000 is what we're talking about. So
What's the value? Did you want to talk about this? All right. So, $32,000, or in a situation when you have gift tax applied and GST applied, which, by the way, the GST, the gift tax, and the estate tax are all stacked on top of each other. So when we were learning about this in school, financial planning school, they taught us that it could actually be more than the gift, and there were some obscure cases where it did add up to more than the gift. But that implies that you were over the $14 million or whatever the estate tax limit was in the year in question. But in theory, you could pay huge amounts, and people do pay huge amounts in gift tax, GST tax, and estate tax over time. So the lifetime cost, and I used 10 years just as a hypothetical example, I don't know, some period of time. It's much cheaper to do the planning, especially as you look at all of those famous celebrities cases where they paid millions and millions of dollars in excess fees completely unnecessarily. So while estate planning can be expensive, $4,000 is a lot of money, it can save so much aggravation, time, and money on the other end. Further reading, is linked at the end of your slides. Those are all, and you can download these slides using the QR code on the first page has a QR code if you wanted to download, and then those links are clickable if you would like. Those are all, I believe those are all blogs on our website, milestonefinancialplanning.com. And thank you so much for listening, everybody, and we really appreciate everybody coming. And please create and update your estate plan. Your family will thank you. And this is how you can access us. Thank you. And thank you very much to Theo for agreeing to do this with me. His experience and expertise is invaluable. Any questions? Yes, Andrew.
I used to just do that you file an annual gift tax return, even if you didn't make a gift in that year.
It depends. Do you need to file an annual gift tax return every single year, even if you didn't make a gift? I believe that answer is
No.
no.
If you haven't made a gift, a reportable gift in any calendar year, then you don't need to report that. Now, I will couch that, I'll qualify that. We talked about gifts into an irrevocable trust, right? Crummy notices,
Right.
annual exclusion gifts. But if we've allocated GST to that trust, in those instances, I feel strongly that the maker of the gift, the donor, if you will, should be filing gift tax returns each and every year so we can track those GST allocations. Because I've had clients pass on and I didn't represent them the whole way through. And now we're trying to back into it and try to figure out how much GST exemption did this person actually have when they passed on. And it's not an easy exercise to go through. It's not a precise science, right? So in those circumstances, I feel strongly that gift tax returns should be filed.
And that's because there is no annual gift tax exclusion for GST taxes for gifts to trusts. So if an
Yes.
irrevocable trust, irrevocable life insurance trust, you have to allocate part of your lifetime exclusion to that, and that's what he's talking about with the GST allocation. So in that case, you would. Any other questions? Yes, in the back.
If I have real estate property, a vacation home in a state other than my own, should I hold that in an LLC or a trust?
That's a great question. The short answer is it depends, okay? If we're talking Massachusetts, it should be LLC owned. So the LLC would own the real estate, and then the owner of the LLC would be your own revocable trust, okay? But I say it depends because if we're talking about a second home in Maine, for example, that strategy is not going to work. So in order for that strategy to work in Maine, the actual LLC would need to serve a business purpose. It just can't be a shell LLC to insulate the real estate from the state level estate taxation. So it depends on the actual state. Vermont, the same rules would apply. Vermont and Maine, they're sticklers about that. Thankfully, as things stand right now in Massachusetts, the LLC doesn't need to be run or operated as an ongoing business. So it really depends where you own that real estate.
Thank you.
You're welcome.
Any other questions? Catherine.
The 37.5 years for the generations giving, does that still apply if it's someone's child and they're just...
And you have your children at 40, like I did?
Yes.
I was thinking that the other day.
No.
Theo?
It doesn't.
No, because if you're leaving an inheritance, if you will, to a child, they're in the next generation, even if that child, no. So in that instance, it doesn't. Great question.
That was a good question.
So, yes.
Anything else? Okay, well, thank you very much. Thank you all for coming. Really appreciate it.
Thank you.
Slides will be available on our website. And so will the video, or the video will be linked on our website.